Right, so we looked at the bank, how we receive different ways we receive cash. So at a point of sale at the register, we looked at how we receive cash in the mail and how we received a check via EFT. Now we're going to learn how to use the bank account to control the cash account. So here's an example. So on the left, we see the company's books. So our asset, cash, and our balance sheet. So our company, we show our beginning balances in cash, our increases in cash, and at the end we'll have our ending balance in cash that we see on our balance sheet. On the right, this is the bank's perspective. The bank will show a beginning balance, we'll show increases, decreases, and then we'll have an ending balance on the bank statement. Well, ultimately, what we show as an asset on our books for cash should equal what we show on our ending bank statement, right? Because cash should equal cash. So how do we get say our cash on our books is different than our cash on our balance sheet? How could that happen? Well, say you write a check to pay a vendor on the July 30th for $400. And that check isn't actually cashed by the person you're paying until the middle of the following month. Well, on your books, you decreased your cash asset because you wrote a check, but that hasn't actually come out of the bank account yet because the other person hasn't cashed the check yet. So you would have a difference between your bank account that you get from your bank statement and your cash account on your balance sheet. To reconcile items like this, we have to do what's called a bank reconciliation. So there's two sides to our bank reconciliation. At the top, cash balance according to bank, that's the number you get from your bank statement. So you get your bank statement at the end of the month, it says $5,000, that's your cash according to the bank. And then we're going to take that bank balance, we're going to add increases to cash not on the bank statement. So that would be, if we received a check at the company, we recorded it as an increase to cash, but it hasn't cleared the bank yet, that would be an increase to cash not on the bank statement. That would be called a deposit in transit. We recorded it on the books, but it hasn't cleared the bank and gone on our bank statement yet. And then we're going to deduct decreases to cash not on the bank statement. So that would be an outstanding check. So if we write a check to our employee on July 30th, we reduced cash on our book side. But if they wait 4 weeks to cash it, that's not going to show up on our bank statement yet for the end of the current month. So we have to deduct that from the bank balance. And then we get our adjusted balance on the top. And then on the bottom, we're going to start with our cash balance according to company. So if we show $4,000 on our books in our asset cash account, we'll put that as cash balance according to company. Then we're going to add recorded increases to cash, deduct unrecorded decreases to cash. So these are things that happen in the bank that we haven't recorded on our book balance yet. And then we get an adjusted balance on the company side. So the adjusted balance on the top and the adjusted balance on the bottom, after we do our bank reconciliation, they should equal. So this is a really good slide. This is our steps in the bank reconciliation process. So our step one, cash according to our bank statement, which is $33.59. We had a deposit of July 31st, not yet recorded by the bank. So that would mean that we received a check on the company side, we increased our cash balance, but it hasn't cleared the bank and gone to our bank statement yet. Step three, we're going to deduct outstanding checks. These are checks that we've written, but they haven't been cashed by the person we sent them to yet. And then step four, there's our adjusted balance on the bank side, which is $2,630.99. Step five, we kind of start over. We take the cash balance according to the books. So $2549.99, that's our cash balance in our asset account, or cash asset account on our books. Step 6, we're going to add a note and interest collected by bank. So what happens is sometimes the bank does some collections work for us, and we get paid interest by the bank for what's in our account. So we add that back to the book balance to get us to our $2957.99. And then we're going to deduct some things. So we're going to deduct a check returned because of insufficient funds. So that would mean that somebody paid us, we increased cash on our book side, but when the bank tried to cash the check, the person had insufficient funds, so this money was never added to our account. So we recorded it on the book side, but it was never recorded on the bank side because they couldn't cash the check, not sufficient funds. Then we're going to deduct a bank service charge for $18 that they took out of our account themselves, the bank did, for whatever service charge they have. And then a bank made an error for $9 on the bank statement that we're going to correct. So if we add up from step 5 down to step 8, our adjusted balance of $2,630.99, which equals the adjusted balance in step 4, so which means we have completed our bank reconciliation. Next, we're going to look at special funds. So one thing is that one popular special purpose cash fund is a petty cash fund. So what this is for is if you run your business and if you want to go buy $8 worth of stamps, what you would do is you wouldn't do a special entry and go through your whole purchasing process to buy an $8 book of stamps. You would take immaterial things like that just out of the petty cash fund. So in our example here, a petty cash fund for $500 is established on August 1st. What this means is that $500 of cash was put in a lockbox on August 1st. So we reduce regular cash and increase petty cash. So from an assets perspective on our balance sheet, it's a zero impact. It's just we're calling it petty cash instead of cash. And with the petty cash fund, when somebody's ready to buy that $8 book of stamps, they'll complete a ticket, give it to what's called the custodian of the petty cash fund who's in charge of it, and then they would give them the cash. And then they would keep a log of everything that came out of the petty cash fund. And then so in this instance, $402 of office supplies and $35 worth of store supplies were purchased. So to replenish the petty cash fund, which means we reconcile it, we actually look at the money that was taken out. So what we have in this instance is $467 was taken out of the petty cash fund. So we reduced cash by $467. We bought office supplies and we bought store supplies, so we record them as assets. And then the other part that we spent was $30 for some miscellaneous administrative expenses, which is, we know expenses reduce retained earnings by $30, and they show up as an expense on the income statement. So 402 plus 35 plus 30, that gets us to the 467 in cash that was spent from the petty cash fund. Notice that we're not reducing petty cash, we're reducing regular cash by 467. The only time we adjust the account called petty cash is when we're setting up the petty cash fund, we're getting rid of the petty cash fund, or we're changing the amount we have in the petty cash fund. But when we're actually paying for stuff like office supplies, store supplies, and miscellaneous administrative expense, we just reduce regular cash. And the word replenishment simply means that we're truing it up. We're recording the assets we buy, the expenses we incur, and the reduction to cash. So on the financial statements, when we report cash on our balance sheet, we have cash and cash equivalents, and we have short-term investments. So if we look we show a total of 52,772 total cash in short-term investments. But the cash and cash equivalents, the 9,610, if we look below how that's broken out. So we have cash, which is cash of 1,648, and then cash equivalents would be a mutual fund, commercial paper, CDs, government and agency securities, that'd be like treasury bonds, and then corporate notes and corporate bonds. So those would be considered cash equivalents. So cash of 1,648 plus the cash equivalents gets us to our 9,610, which we show up top. And then short-term investments would be investments that are short-term that we can convert to cash quickly. And that is the end of chapter 5.